Hey everyone, welcome back to the channel. So today we're going to do something a little bit different. If you haven't noticed already, you don't see me. I am not in front of the camera today. Instead, what I want to show you guys is a couple charts that I've been looking at and to share my analysis of the current US and global economy with you. So as you guys know, I do quite a bit of trading in traditional equities markets as well as cryptocurrency. And I've been monitoring the markets lately, and actually not just lately, but over the last couple months and even last couple of years. And I've been seeing this large pattern play out over the last couple months, and I've been working it into a larger theory on where the global economy is and where we're headed in the next couple months to next couple years. And I think my findings are actually quite important, important enough that I want to share with you guys, and important enough for me to share with my friends and family as well. So in front of me, you see at the top the US 2-year bonds minus the US 10-year bond yields. And on the bottom of the screen, you see the S&P 500. And there's quite a bit of information marked up here. And I'm going to go into it in just a second. But before we get there, I want to give you guys just a little bit of context on why I'm talking about this and why you should stay and watch to the end of this video. So let's rewind a couple months back to March of this year, when the coronavirus was making its way around the world, and there's quite a bit of panic and fear in the markets. During that time, as you can see if I zoom in, the US stock market and many markets around the world had quite a large correction, crash to the downside. So as you can see, since those lows in March, we've recovered quite nicely, and we're now at the top of this range here. So the question becomes, what's next? Have we totally recovered? Are the markets going to head higher? Are we safe from more downturns? Well, unfortunately, the answer is no. From everything that I'm seeing, the markets are still in a very precarious place, and I definitely think that there's a larger downside ahead, and that's really why I'm making this video. So before we go into the charts in front of you right now, I want to show you guys some different charts. And these are charts that I've made during the crash and actually before the crash. And the reason I want to show you guys this is to give some context on my background as a trader, as well as really what I've been watching and observing the last couple of months and even years. So we're looking at tradingview.com, and this is my kind of anonymous account that I've created called Target Sir. You can come and you can take a look at these charts yourself. They're all published and public, and after I publish them, I cannot edit them. So you can rest assured that any of the charts you see here are charts that I've made well in advance and are not made up or modified after the fact. So let's go back to this chart here. As you can see, this is April 4th of 2019. Actually, let's look at SPX. I have two here, SPY, SPX. Let's just look at SPX. It's actually the same chart. And what you can see here is we have, what I've drawn is a large Elliott Wave pattern. In Elliott Wave, this is an impulse. An impulse is made up of 5 moves. You have wave 1, which is an upward move, followed by a steep correction. Wave 3, followed by a shallow correction, and then wave 5, which is the end of the impulse move. And after wave 5, normally that's followed by a correction. Again, this chart is from April of 2019. At the time, we had just recovered from a bit of a crash. At the time, we came down, hit this Fibonacci number at 0.236, and basically not wicked, but bounced back up. And at the time, I was trying to evaluate this crash and see where we're headed in the markets. And based on my Elliott Wave analysis, I figured that that was part of wave 4. However, at the time, I still had some doubts. And mainly that was because this correction that came down and hit the 0.236 area is actually a fairly shallow correction for a wave 4. Most wave 4s land between the 0.236 to the 0.382 level, with 0.382 being the most common and highly probable area. So it looked like, based on this geometry, that this wave 4 was a little bit shallow, and compared to the rest of the geometry, it looked like it lasted kind of too short in duration. I would have expected wave 4 to take a little bit more time. In Elliott Wave, a wave 2 correction is normally the steepest and most violent correction during this 5-wave impulse. And wave 4 is known as being a shallower correction, but a correction that actually is more sideways and lasts longer. And as you can see from this chart here, wave 2 took quite a bit of time, but this wave 4 is pretty minuscule. So as you can see from this chart here, wave 2 took quite a bit of time. It actually took from year 2000 to 2008 and 9 to finish that correction. And at the time, this wave 4 correction only lasted a couple months. So those two corrections were seemingly at odds with each other. But what I was able to do with the geometry here was project out what a wave 4 could look like, and also what a wave 5, the last leg of this bull market, might look like as well. And if I go and play this chart here, you can see that actually during this March crash, we came back down and hit very decisively this target area for the completion of wave 4 between the 0.236 and 382 level. And now we have reversed off that point as expected and are finishing this wave 5 impulse. And that will conclude this entire bull market run actually. So as you can see from this chart, I have the end of wave 5 projected to be around 3,800 to 4,000 points on the SPX, somewhere in this red box here. Now I also made a similar chart based on the SPY data, and you can see that we also hit this wave 4 box, and also if I play this chart, ended up now in the wave 5 termination area in this red box as well. So based on these two charts, which are both made a year in advance, the stock market has basically done more or less exactly what I've expected. And that's great because I'm quite happy that my projections were accurate. But it also puts us in kind of a predicament because after wave 5, there should be a large correction that's going to correct this entire move up. And I'm going to talk about that in just a few minutes. But first, I'd like to take a look at this wave 4 correction. So if we scroll up and we look at this chart here during the middle of the correction, I have a chart called the DJI SPY Elliott Wave Wave 4 expanding triangle. And what you see here is you have the Dow Jones Industrial Average on the left and the S&P 500 index on the right. And if I zoom in on the DJI chart, you'll see that the same pattern that I've drawn out on the right here is also present on this left chart as well. They're pretty much mirror images of each other. Now, the rule for triangles in Elliott Wave is that they can only appear in wave 4 of an impulse or in the B correction wave in an ABC. In our case, what we really care about here is this wave 4 triangle. As you can see in this chart, which is similar to the chart that I created back in 2018, I had this labeled as 1, 2, 3, 4, 5. So this is, according to my chart here and in my chart a year ago, the wave 4 area. And as you can see, this triangle played out pretty nicely. A, B, C, D, E. And after E, if we play this chart, you'll see that price reversed decisively off this low and is now making new highs. And again, you see the same thing in the Dow Jones Industrial Average. In this case, I've also made a projection for the end of wave 5, which is about 3,000 points on the DJI. And as you can see here, we've pretty much hit that point, just as we have in my previous chart for the S&P 500 as well. Now, I wanted to show you guys this website, ewtaf.com. You can also go on Google and just search Elliott Wave, Wave 4 Triangle and come up with a similar website that has the same information. Elliott Wave, if you're not familiar, is a set of rules for how price moves in any market. This triangle pattern is just one of many patterns that make up the Elliott Wave theory. And as you can see here, there is a diagram that looks eerily similar to the S&P 500 triangle that I just showed you. And the way this triangle works is that in a bull market, price action comes up and starts correcting. It goes A, B, C, D, E in this 5-way pattern, and that completes a correction, at which point price will resume its prior trend, which in this case would be up. And if you go to this website, you can go through each of these rules and see what qualifies as a triangle. I've already done that, and I verified that the wave 4 triangle that I'm seeing in my charts satisfies all of these rules here, as per Elliott Wave standards. Okay, so as you can see, the charts that I made about a year ago played out, and this triangle that I was tracking also played out. And the confluence between this wave 4 triangle playing out perfectly, combined with this larger, longer term Elliott Wave picture that I've had, gives me a lot of confidence in what is going to happen next to the US stock market. But because as a trader, I always want to verify what I'm seeing with additional data out there, just to make sure I'm not biased, I want to show you guys this chart from Ray Dalio. Ray Dalio is a billionaire hedge fund manager who's gained a lot of popularity lately after releasing his book called Principles and also predicting a few economic crashes. And I was able to find this slide in his lecture, which correlates the yield in short-term and long-term bonds with the position we're in the larger debt cycle. So as you can see on the slide, this top graph is of the difference in yields between the short-term and long-term bonds, and this bottom graph shows the corresponding price in US equities. As this curve increases, so too do equity prices. And after this topping pattern, as this yield curve falls, we also see equity prices fall as well. So what I've done is I've taken this curve and these numbers from Ray Dalio's charts and I've regraphed it in TradingView along with the S&P 500. So if we look at these charts and I scroll through it, you can see that in the beginning, there's not much correlation between this bond curve and the performance of the stock market. In fact, as the bond curve was falling, equity prices were rising. And that happened to about year 2000. At which point we hit this topping pattern in 2000, and then as this yield curve fell, we saw the stock market also crash. After which this yield curve increased, and then it crashed again. And from this point, we saw that at every major top in this yield chart, we also saw a corresponding crash in the US equity markets. Now we're at this point here in this yield graph, and according to Ray Dalio's charts, we're pretty overextended. You can see prior that every time we've hit this trend line, we've bounced down from it, and that's signaled the top of this curve. So comparing to Ray Dalio's charts, we could see that this correction should end around this area here, and you can see where we are right now, which is here. That means we still have plenty of room to the downside potentially. And I've also mapped out the time frame in his chart, where he calls for about a 12 to 36 month correction. If you can see here, generally the depression lasts for about 36 months, after which the economy starts to recover. Here, each blue line corresponds with 12 months since the correction. So here's 12, 24, and 36 months. So based on this, you can see that according to Ray Dalio's charts, the markets still have plenty of room to go for the downside, and there's still plenty of time for this correction to play out. Still another 24 months or so. Now, going back to this Elliott Wave chart, and why this is so concerning to me. Because this wave 4 triangle played out so nicely, I believe that it's really validated my count here, and I have a lot of confidence in what I'm seeing here and my labeling. And if that's the case, after again a 5-wave impulse, wave 1, wave 2, wave 3, wave 4, and wave 5, we should see a sizable correction. Now what makes this correction different than the correction in March and the correction even in 2000 and 2008 is that this correction is not going to just correct the prior couple years of price action up to it, but it's actually going to be correcting this entire price action, this entire 5-wave move. That means it's going to be correcting price action all the way from even before 1980. Now the way Elliott Wave works is that each wave is actually fractal in nature. That means for every wave, inside of it, it's built of other smaller component waves. And that wave that you're looking at is itself part of an even larger wave. So in this case, as I've said, we have wave 1, 2, 3, 4, and it looks like we've just completed 5. These 5 waves in and of themselves are made up of many small waves, but they also create one larger wave. In that case, that would be a large wave 1 wave. That means if we're to zoom out and create this chart, we can actually draw a larger Elliott wave that's made up of this wave here. And that would look something like this. Whereby the price action that we've seen since most of the modern era just makes up wave 1. But because that makes up wave 1, we also have this wave 2. And that's what I want to talk about right now, this larger crash that could be about to happen. So being that this is actually one large wave 1, and now we're looking for a wave 2, the wave 2 correction is typically what's called a zigzag corrective pattern. And a zigzag corrective pattern is both the most violent type of correction and also the one that retraces the most. Typically, the retracement level for a wave 2 correction is anywhere from the 50 to 61.8% level. And you can see that in this chart here. I have the 50% and 61.8% level marked out. Now, the 50% level is going to bring us below the March lows and actually into price action that we haven't seen since 2014. And if we hit the high probability area for a wave 2 correction, the 61.8% level, that means we're going to see prices back at the year 2000 or 2008 area. Now, if this correction really becomes violent, we could even see a 78.6% correction or more. And this would be by far the largest correction that we've ever seen. This would be the largest correction of our generation and of the last 100 years or more. Now, we've looked at the Elliott Wave count on the S&P 500 and also what bonds are telling us. Let's look at some other indicators that I pay attention to. So here's an image of the Wall Street cheat sheet. It basically shows the different stages of a bubble. You start out this hope phase, and as price increases, you end up at the euphoria phase. So as I've explained from a previous video, these phases in the market cycle correspond with distinct emotional feelings and also different participation by different types of investors. Here's another chart of the same phases of a bubble. You can see that in the beginning, you have the smart money, followed by institutional investors, and towards the end of the cycle, that's when public participation starts to come into play. At the top of the cycle, near the blow-off phase, you see things like new all-time highs every few days. At that point, everyone believes that the market is going to go higher. Everyone's piling in and scared they're going to miss out on the remainder of the bull run. So if you look back at the current market sentiment, and you look at the headlines that say huge participation from retail investors are using Robinhood, their mobile phones, and are buying the dip. Buying the dip has been the trendy thing to say for the last couple of years. And all that signals to me that we're towards the end of this cycle. Not only are interest rates at zero or negative in many parts of the world, but debt is at an all-time high in the US government and in a lot of corporations. Over the last couple of months, COVID-19 has bankrupted many businesses, and many businesses are under a lot of pressure right now. But still, markets are making an all-time high. If you take all of that and add it up, markets are basically disconnected from reality, and price action from what we've seen can only go up. I mean, some companies have gone up 2, 3, 4, even 5 times since the lows in March. And many companies, especially tech companies, are at all-time highs. Just for example, here's Apple at the top. You can see that we've definitely entered this phase of just sheer vertical price action. And at the bottom we see Tesla, which is now worth more than many top auto manufacturers combined. To me, all this looks like euphoria and the bubble top phase. And so as we approach this top in the S&P 500 and hit these targets that are measured moves according to Elliott Wave, we're going to start seeing these bubbles pop. And as these bubbles pop, that's going to pull us lower and lower. And I think there's a high chance that we're going to see a big correction over the next couple of years in US equities. And not only US equities, but the world. Nowadays, modern economies are all linked together. We've seen negative interest rates in many parts of the world, and the US economy is one of the few global economies which hasn't hit negative interest rates yet. What that means to me is that global economies have been topping over the last few years, and they're simply out of sync. The US economy, because it's been stronger, and because the US dollar is the global reserve currency, has been able to hold on and continue to move higher over the last couple of years. But all of this is going to soon come to an end. Now, that doesn't mean you should go out and sell all of your stock now, but you should be careful and mindful of where things are headed and what the larger picture is. It's possible that we still go higher to these other projected Fibonacci numbers, but I think the probability that we're close to a large correction, especially after this largely uninterrupted move from the lows in March, is highly likely. So please be careful out there and stay vigilant, and I hope that this information proves useful to you guys. If you liked this video and found it helpful, please let me know in the comment section, and please like this video. Doing that lets the YouTube algorithm know that you enjoy this content and makes it possible for me to continue to make content like this. And also please subscribe because I'm going to continue to create great content that I think will be helpful to you guys. Till next time, take care and thanks for watching.